Good afternoon, everybody, and thanks for joining once again for Friday's Learn and Grow Meetup. I host or facilitate educational meetups and webinars every other week on Fridays and bring some interesting topics on real estate, multifamily investing, and syndications with some great guests who are the SMEs. Today, our special guest is Ruben Greth, and our topic is capital raising, the inside story. A little bit about Ruben. Ruben has a popular podcast show. It's called The Capital Raiser Show, where he interviews multiple syndication attorneys and also talk to different capital raisers and learn about their strategies, like what strategies they use for capital raising. And from there, I think he has created his own blueprint for capital raising, which we're going to be learning from him today. But before we get started, I would like to go through a small little disclaimer. This session is strictly for educational purposes and should not be considered as a legal, accounting, or investment advice. This session does not represent an offer to sell or a solicitation of an offer to purchase an investment or security. The strategies mentioned in this presentation may not be applicable for everyone. The information presented is believed to be accurate and reliable. We make no representations or warranties expressed or implied as to the accuracy of such information, and we explicitly disclaim any and all liability that may be based on such information and/or errors or omissions thereof. Please consult your own attorney, financial advisor, and CPAs for legal matters, investments, and any specific tax situations. Once again, this session is strictly for knowledge sharing purposes. So Ruben, all yours. Tell us your story.
Really excited to be here. Honored to be in the presence of great people here. And we're going to chat it up about capital raising today. I don't have a formal presentation, but as many of you know, I do have a show on raising capital. And I talk to a lot of syndication attorneys on a regular basis and have gathered quite a bit of contradicting information from them and really try to put all the pieces together as best as I know how. And, you know, with what makes sense to me. Yeah, I think I would make it pretty brief, but just so that you guys understand the whole progression of the capital raising mindsets that I had along the way, I'll probably spend about 2 or 3 minutes talking about how I got here and what I learned along the way and what I have learned recently. So I started with a meetup back in 2007. That was geared for real estate investors. I was trying to be a connector of people and I couldn't really figure it out because my mind was scattered. I had been in an educational program that taught like wholesaling and rehabbing and probate and subject to. And one of the classes that I took was on multifamily. And that's when I got my introduction to large scale investing into big deals. And this particular instructor named Johnny Dessauer never mentioned the word syndication. So it was many years later before I even knew that raising capital for these big deals is very different than the way that you raise for small deals, whether that's single family or multifamilies like fourplexes and 12plexes and stuff like that. And in my meetup, this dude came into town. I had a background in Wells Fargo mortgage lending. I was in the Spanish department, so I had access to all their products, their home equity, their FHA, their no doc loans, et cetera, et cetera. And this dude came into town. I had him at my meetup, and he was just like recently bankrupt. He had lost all his money in spec homes right during the crash, but was very confident, moved to Phoenix and started buying all of these fourplex at the time in 2009 or so. We were having a fire sale here in Phoenix. So like there was some sort of proposition that passed that that made it very challenging for undocumented workers to get jobs. And Sheriff Joe Arpaio was cracking down on a lot of this. So he kind of drove a lot of the Hispanic population out. And with the crash that happened simultaneously, there was all of these empty fourplexes all over the city, and you could pick them up at less than $20,000 a unit. And they were almost essentially turnkey. Like you'd go in, maybe put in some tile and some countertops, and then throw in some B or C class renters in there, and you were done. And you were cash flowing astronomically because you could rent them at like $550 a unit. You know, we were taking down 2 bedrooms, and a lot of them had already been like rehabilitated. They had brand new roofs, you know, like as long as you went in there and made sure that the plumbing was still there and the electric wasn't yanked, you were basically going to ridiculously cash flow astronomically. So we kept doing this over and over and over and really developed a system. And I was like in this connection mode. I wanted to connect people together. So what I did was I followed this guy around after he explained to me that he wasn't financing these fourplexes. He was taking them down with investor capital, because that's how you had to do it. I mean, especially with the bankruptcy, no one was going to lend you any money, right, Julie? Okay, so we would go to his fourplex projects. He would discuss how we found them, what, you know, mindset to have, particularly around like, you know, rich dad, poor dad was kind of big in those days. So we would talk about accumulate assets, don't accumulate liabilities, and kind of share investor perspectives and talk about this particular moment in history, which we believed was going to be the biggest transfer of wealth in the history of real estate. And it turns out it was true. People that bought a fourplex back then pretty much have tripled, quadrupled, or quintupled their equity in those deals as long as they held them, which unfortunately for my small mind, I did not. I was like, hey, let's raise some capital for these and let's flip them and then make some money along the way. And if I had kept all of those little fourplexes that we bought, I would be like very rich right now, which I'm just kind of middle class right now, struggling to get through and get to the point where I have true full-blown financial and time freedom. But so he and I kind of split up because he was telling me, hey, you know, you raised $625,000 for these just through YouTube. Focus on the marketing. We don't need 2 machines that are going to buy all these properties. I'll handle the acquisitions and the micromanaging of the contractors and getting them rented and putting them back on the market or keeping them, et cetera, et cetera. And I did. So we were going to go crazy. We were going to write a book. We were going to do a CD series. We were going to go on tour. And I even flew a producer into town from San Diego that was going to film a mini pilot promo that we were going to pitch to A&E and kind of talk about cash flowing assets, because everyone at the time just had flipping houses kind of TV shows. But he started not showing up for these marketing meetings. We split up. And then since I was in sell my fourplex mode, I sold them all, ran out of money, ended up back in corporate America with no partner to promote anymore. And I wasn't able to adapt and pivot and do it on my own or raise capital without promoting somebody. This is the limited mindset that I had. And I had this other mindset that many people have, which was that multifamily partners don't grow on trees. Now having the show, you know, I see multifamily investors everywhere that you can partner with. But so after I split up with him, ended up back in corporate America, and I can't be behind a desk. So one day I quit and camped on every beach from here all the way to Acapulco down the Pacific Mexican coast, met this beautiful woman in Acapulco, and then spent about a year in Playa del Carmen. We kind of had planted seeds together that we liked each other, but we lost contact. And then eventually she came back into my life, and now we're married. So from this particular trip, at the time I was like, yeah, I broke up with my real estate partner. This sucks. And then I realized that God had other plans for me, which was to send me to Mexico to go meet this lady. So I'm really glad that this partner, like when you break up with partners and bad stuff happens in real estate, there's probably some greater reason that we can't understand in the moment. But I just wanted to throw that out there. So I come back to the United States and I found out about this thing called syndication because I wanted to do a bunch of fourplexes and built this plan to buy 32 of them, 128 units. I calculated that would, if I paid the equity down, that would provide me enough cash flow for the rest of my life to handle everything. And I could basically have the time freedom I wanted. And I shared this plan with somebody at a real estate meeting at the local ASREA, the investor association here. And somebody was just like, 128 units. Why don't you just go buy them right now? And I was like, wait, I don't know how to do that. So that's how I learned about the word syndication. I was in a car accident and tore both of my shoulder labrums. Eventually, after getting rehabbed and everything, I was going to get a nice check back from the insurance company. I was like, I'm going to spend this on a guru that's going to teach me the syndication business. So I interviewed tons of gurus, like the Jake and Ginos, the Vinny Chopras, the Annie Dickersons, the Joe Fairlesses, and et cetera. There's a whole bunch in Texas that, you know, we could list just like for an hour, the ones that are in that state. But what ended up happening is I interviewed a local syndicator and told him that I really wanted to find out, how do I do this? Like, who do I need on my team? And they're like, well, what do you care? I'm like, well, I used to raise capital on YouTube. I have a social media presence. I was good at it. I've been kind of out of the game for a while, but I see multifamily as a tool for creating generational wealth. And I'm, you know, I want to use my expertise in marketing, help me out here. You know, like who else do I need on my team besides my skill set? And they're like, what? You raised money on social media and you're interested in multifamily? Why don't, instead of you going and getting a guru and building a team, why don't you just join our team? So I hung out with them. They were a mom and pop syndicator here in Arizona doing heavy lifts, and they were raising capital completely wrong. And I did not know that. They thought because they moved from the single family space into the multifamily space, that if you could find a good enough deal, the money would come. And we found out very quickly that that is absolutely the wrong approach in multifamily. So I came on board, learned some marketing, started a show to get exposure. And I figured if I'm going to do a show, like Joe Fairless says, you need an interview-based thought leadership platform. I'm going to do a show specific to capital raising. I might as well learn from the best and find out how they raise capital, because the only way that I've ever raised capital is from joint ventures. This whole syndication game is completely different. Did like the first 50 shows was all about raising from limited partners. And I started getting this exposure and meeting capital raisers and meeting sponsors, and eventually got to the point where I was like, you know, maybe it would be nice to have access to these deals in other parts of the country that are not necessarily heavy lift properties, because that's what my team did in just one location in Arizona. So I was like, everybody likes the Southeast. Some people like Phoenix. We weren't investing there. We were investing in Tucson at the time. Some people like Texas. How about I take these capital raisers that I've met and these sponsors that I met and put them together? And I was like really trying to figure out, how do I do this? And since I was interviewing significant amounts of attorneys, I'd ask them this question: how do I become a facilitator for this? And the overwhelming response was, you need to start a fund. In order to legally raise capital from capital raisers and put them in contact with sponsors, the only way that you can legally do this is by starting a fund. Now, there's also the option to be a co-GP with somebody, and we'll talk about here in the differences between raising from LPs and co-GPs. But for my mindset, because you can't raise from people today that you haven't spoke to and planted seeds with and nurtured from yesterday, you have to have been planting seeds for some time. You can't raise today from people that you haven't spoke to yesterday, was the thing that I wanted to say. And I figured the fastest way to help this particular team was, instead of going through this really long process of nurturing and helping people understand our business model, is to just go get a couple of co-GPs, some people that's got like $500,000 worth of investors, and they want to have their next level up, their GP card, their co-GP card. And I started attracting those types of people as a mechanism to get capital in the door faster, and it worked successfully. I brought a couple of co-GPs into our deals. We gave them a piece of our company. We made them officers of our company, and they brought their investors. We took down a 90 and then did a hotel development. And then my team specifically at that time was not really interested in raising for other teams. That's something that I started getting interested in. So I decided to leave that company and then go launch my own fund. And I did it right in the middle of a capital raise that I had already raised $400,000 for. Now, to be SEC compliant, when you raise capital, in order for this to be legal and you to get paid, it can't be just for the money that you raised. You actually have to have an ongoing duty. And I did not want to have an ongoing duty with this company. I wanted to go spread my wings somewhere else. So I left my GP slice, walked away from money that could have been put in my pocket, so that I would have an opportunity to go make more money somewhere else. But it was super scary, because now I wasn't raising for somebody else. I was raising for myself. I was going to have to go find a fund. I was going to have to create my own marketing. I was going to have to do all of the CRM and automations and building the website and paying for the syndication docs. And I was pretty terrified, but something inside of me said, this is what I have to do. I have to leave this team. I have to go get better and stronger and develop myself. But because we were in the middle of a capital raise, I didn't want to disrespect what that company had done or the money or the investors that I had brought. So I left very quietly and went underground for a little bit. One person that I had interviewed on my show had found out that I left that company, and he was a fund manager. His name's Andy McMullen. I think a lot of you guys know him. He already had experience with funds and had previously raised 30 million. And he was good at talking to sponsors and making those kind of connections. What he really wanted some assistance with was with all the marketing, the rebranding of his website, the implementation of automated emails, the national exposure that my show brought. So I came on board with him. And instead of launching my own fund, which would have cost anywhere from $7,000 to $25,000, I got to save that expense and partner with somebody and utilize their and leverage their track record. And they could outsource the things that they no longer wanted to do, which is all the marketing and national exposure and getting in front. So it's a very cool, unique marriage where the marketing skills came with the capital raising skills. And we now have a fund. And all of a sudden, in a 2-year span, after having been gone in Mexico and trying to figure out how to get back into real estate, I'm a fund manager now. You know, I'm a managing partner of a company called Legacy Acquisitions. And we do a couple of things, right? So we are focused on build to rent in Louisiana and have a couple other projects that we're going to be raising for down the road that are coming down the pipe. And then the other thing that we do is we raise capital for other existing sponsors. Not everybody in our database is going to understand build to rent or see how lucrative it is. The trendy kind of LP investor that's somewhat sophisticated, but not super sophisticated, really wants the same thing based off of what I've heard over and over from people that I've talked to and surveyed. They want big deals in big markets that are cash flowing from day one, typically. And, you know, one of my problems with this particular mindset of the trendy LP investor was that if this is really the case, that they're coming to me and saying, Ruben or whoever, I want to create generational wealth. I see multifamily as a vehicle to create generational wealth. That's what they all say. But then even though that's what they say, they get into these trendy deals that are 3 to 5 years, and they basically become passive flippers, right? No hands on, they flip in and they have capital gains at the end of 3 to 5 years. And then they have to do it all over again. And if they had poor communication with the sponsor, they have to go find a new sponsor and do that whole thing. And really, I didn't see anyone creating generational wealth by passively investing, except for a few groups of people that I have known that they've been called or are called family offices, which really have a long-term vision for their great grandchildren. They're accumulating passive investments, but they're keeping them. And I really like this particular model, which I refer to as legacy investing. It's when you buy an asset as an operator, you bring some limited partners in there, and then instead of selling the property in year 3 or 5, you just refinance, give the limited partner their original capital back, just their principal, but you keep them in the deal. So they don't have a tax consequence because they're only getting, maybe they probably have to pay some taxes on their cash flow unless their cost, you know, unless there's cost segregation on the property, which will be a topic for a different conversation. But when they get their principal back, they maintain the equity share that they had. They can take that $100,000 in this particular hypothetical situation, redeploy it into another asset with the same sponsor or another sponsor, and then in another 3 to 5 years, do the exact same thing. And now their $100,000 investment gets into 3 or 4 or 5 deals, depending on how long you stay in. And this is what we call as the legacy model for creating generational wealth, which very few syndicators do. I know of a few, but they're very uncommon. And I kind of understand why, because the limited partner or the people that sell to limited partners typically can create the greatest amount of internal rate of return for their investors in those first 3 to 5 to 7 years, because they can maximize their payments or get the most from the use of the interest only period. They can capitalize on the cost segregation, and just basically it's going to give them the most amount of return on their money. In fact, sometimes these sponsors, they don't even have to finish the business plan and complete the units in order to get their projected returns. But when they sell, this is creating a capital event and a taxable event for their limited partners. So let's kind of talk about this. There's two branches that my company kind of focuses on. We have this, let's go build and nurture a database of investors. That's going to take, 6 months to 18 months, maybe longer. And then let's have this other branch where we go and focus on raising from capital raisers. So we'll start talking about what are the options to bring capital raisers in. And the capital raisers, there's a couple of options. If there's somebody out there that's got access to, let's just say $500,000 worth of partners or limited partners, they've been planting seeds, they don't have really any major syndications at this juncture in their history, they kind of have a few options. One, they can become a GP themselves, which is going to be kind of troublesome because they're not leveraging somebody else's track record. The other option they can do is they can partner with an existing operator, but then they have to kind of create a co-GP negotiated agreement. Like, what am I going to get as a capital raiser? What else am I going to be doing in order to stay legally compliant within your business? Because I can't get paid only to raise capital. I have to do something ongoing. Or the other option, which we're very attracted to, is to start a fund, or we can recommend that people in this situation go and start a fund. But that has its own inherent problems because you got to pay $5,000, $7,000, $15,000, $25,000 to pay for that. And the first thing the limited partner is going to ask is like, hey, you got this fund. How many of these have you done before? And if it's your first one, they're going to be like, no, thank you. So one of the sexy options that we kind of can provide for people in this situation, which is something I recommend for anybody that's in my situation that's looking to get capital raisers. If you have your own fund or have a GP team with a track record, launch a fund and then bring capital raisers into your fund. The capital raisers will take a ownership share of the fund, and then that fund will invest into other people's syndications as a limited partner. And by definition, a limited partner cannot take or participate in any ongoing duties. So now you can kind of be hands off. You don't have to do any management, acquisitions, help with any of that stuff or operations. All that you can really do within your fund in this case, and stay legally compliant, by the way, is manage your investors, communicate with them, make some decisions together with them, whatever that looks like. But now you're not actually operators. So this is a very interesting thing. Is there any questions so far about this? Let me open up the chat. Hello. Okay, so we got some hellos. All right, anybody here, just out of show of hands, anybody, hey, what's up, Stony? Anybody here have a fund or thinking about launching one? Put a 1 or a yes in the chat. Just curious about this. So I don't see any active. Okay, so we got some ones. Jim's wants to start. Julie wants to start. Jeff wants to start a fund. Okay, so a couple options here. Now that somebody's wanted to start a fund, what are the options, right? You go to a syndication attorney, and they're going to give you, let's say that you go to multiple syndication attorneys, they're all going to give you different stuff. They're going to tell you about different fund structures, about different things. But essentially, this is the problem with talking to attorneys, is they can only give you legal advice. They cannot give you business advice. And this is a major drawback. So there are some existing business advisors, or what they refer to as fund architecture consultants. Because if you talk to an attorney and you're like, hey, I'm going to go launch a fund, they're going to write the docs for you, but they're not going to tell you, hey, your business plan makes sense, or maybe you can't even raise, or based off of your juncture, if you don't have a bunch of limited partners in your database already, you're going to fail miserably. They just want to take your money and write docs and protect you and your investors. That's their job. So I recommend, if you're going to start a fund, there's a few names that I will mention. Joel Block is somebody you should be connected with. Ike Mutabana is somebody you should be connected, and Lance Peterson are all people that will give you some advice about the different types of funds and give it to you, give you the advice. And none of these people are legal counsel, by the way. They're business guys that will look at your model, what you're trying to do, and say, you know, like, you're never going to raise a penny, so you should stop right here. You need to go build this database out before you think about launching a fund. Or they'll say, hey, okay, so this is how you pay your investors. This is how you structure your syndication. This is this, that, and the other. Now that you know exactly all the hurdles that people have fallen through, and, you know, crevices that they've fallen through on their way up to the top of the mountain, let's structure your syndication like this so it makes sense for you. And then they will turn that over to an attorney. They can either be theirs or yours. And then you can use that business advice to help you put together your first fund that makes probably the most sense for you, because as brand new fund managers or people that starting their own fund, you don't know what you don't know, right? So, and the lawyer's not going to tell you to do anything unless you put it unless you tell them to put it in the docs. And then, you know, if you start it, a fund going directly with an attorney about a year into it, you're going to go, I wonder if I could do this in my fund. And then you're going to realize it's not there because you didn't tell the lawyer to put it in the docs. And that's a real shortcoming, because now you're stuck with the legal documents you created that people signed way back, you know, during your investment offering. So the best, I got a question coming. Could you please give us the best strategies to use to raise funds and to make people trust you to invest? So a lot of that comes to nurturing, and you can do this within a fund, or you can do it in a co-GP, or you can do it before you ever do a syndication. But a lot of that comes to being consistent and communicating effectively with your investors and providing value over long periods of time. If you have a show or podcast, you want to be consistently putting out content. If you have social media presence, you want to consistently put this content out, or whatever content you create, and be creative, and don't just put junk out there for the sake of putting it out there, because people will be like, this is a bunch of crap, and you'll actually be worse off than if you had not posted at all, because they'll be like, oh, this guy is just lame, or this woman is just lame. So you want to be putting some amazing content out there as possible. But I asked many people on my show, particularly Neil Bawa, what's the best marketing tool that you can use to raise capital? And he said, well, there is none. You don't use just one or focus on just one. You focus on a lot of different things. You need the social proof by networking and meeting people on phone calls and seeing them at conferences. A meetup would be great, and a podcast would be great. And then email communications and all the social media, like when they see you in different places and hear your voice and hear your name in different places, and that's what really starts to make you reputable. That consistency too, like during COVID, you might have noticed some people disappeared or didn't notice them at all because they disappeared. But the people that were trying to be leaders or stay strong for their investment, for their investors, better said, were the people that continue to communicate both on social media and personally during COVID. So these are things to contemplate. And as you're building a fund, you want to be doing the same thing. So we have a database of investors, but we want to grow it. And so how do we do that? It's by all of the things that I just mentioned, right? And communications is probably the biggest key to it, because if people are constantly receiving an email from you, you may think that you're spamming them and they're not opening them, but in their mind, it's registering, this guy's sending out communication. Let me open it up. You know, occasionally they're going to see what's in there, if it's good content, if there's any kind of brand or feeling that they get internally from it, and then they close it, and then they see the emails coming through and they don't open it. But you're kind of registering in their brain that you are going to be around, that you're not going to disappear, that you're going to continue to communicate. And when they are ready to invest, they'll remember not necessarily every email that you wrote, but the fact that you wrote an email every week or every 2 weeks or whatever your cadence is. But so now going back to the fund, we have a couple options here. Like, what kind of a fund do I start if I'm going to raise money? You can do what we refer to as a specific purpose vehicle or entity or fund for just one project. And we're actually doing this with our build to rent. We're basically raising for this deal, and then once it's raised, it's done. Like, we never use that fund again. And this is called a specified offering fund, or some people, it can even be considered a syndication, or better said, a syndication can be referred to as a fund, because it's the same thing. You're crowdfunding, you're pulling investors in. In this case, the fund invests into somebody's deal, or in this case, our own deal. But the other option would be to have a semi specified offering fund, which would be like, if you're going to do just one raise, but it's going to be for a portfolio. Hey, there's a deal here and there's a deal down the street that we're raising for. This is going to be a two-part thing, or maybe a portfolio that consists of different properties in the city. But once that money is raised, it's over. So the other thing that you can do is start a blind pool fund, which is when you attach a business model, not a property, to your fund. You basically say, hey, everything that we're going to be doing over the next 2, 3, 5 years, however long the duration of your fund is, it's only going to raise for this type of project. We have a blind pool fund set up for all of our future build to rent projects. And we're going to say, anybody that invests in this fund, the only thing they're ever going to have access to, and the only thing that we're ever going to acquire, is build to rent projects that follow this specific model. You're not going to see value add multifamily or storage units or ATMs or oil and gas or anything else. It's just going to be one thing. And some people who have developed and built out numerous funds, they can be a little bit more broad and expansive in what they attach to their business plan. They can say, hey, we're going to do value add multifamily over here. We're going to do hard money loans for single family over here. We're going to be buying development projects here. We're going to be doing all these things. And then you just basically got to trust me. And the money that you put in here is going to be diversified amongst all this stuff, but you have no control over what you're going to invest. And this particularly is the hardest type of fund to raise capital for, because people are blind. They absolutely have to have complete trust in you that you're not going to make any mistakes, and that over, all of the properties that you do, there's not going to be one that you do that's going to pull everything else down. And you have to have a supremely good track record in order to do this. I did ask Kim Lisa Taylor on my show with her. I'm like, hey, if you're going to start a fund, do you have to have a marketing machine? Like, you have to be like a Grant Cardone? And she said, yes, like you really do need to have a marketing campaign that goes, that basically, is Grant Cardone style, where you're constantly feeding people into it. And then I had Joel Block on my show, and I'm like, hey, I talked to an attorney and asked them if it's true that you need to have a marketing machine to, before you launch a fund. And he said, see, this is exactly why you don't talk to attorneys, because they can't give you business advice. And he said it and put it to me like this. He's like, if you want to have all kinds of problems, then go out and get a bunch of investors that you do not have a relationship with and put them into your deal. And I thought about that, and that's exactly what Grant Cardone does. No wonder he's getting sued all the time. So when you're starting a fund, it makes sense, before you put people into your fund, that you have the capacity to raise from people that you already have existing relationships with. And this is the type of advice that a business fund architecture consultant is going to give you. So this brings us to the next kind of most sexiest kind of fund that I've seen. And this is what I refer to, and different lawyers will call it different people, and different sponsors will call it different things. I refer to it, and Kim Lisa Taylor refers to it, as a deal by deal segregated fund. And in this particular kind of structure, it's not blind, because you open up the fund and you can raise for a variety of different deals, and hopefully they're all the same business model type, right? So they're all value add multifamily, especially if it's your first fund. They follow one thing and it's not too expansive or broad. But what happens is, you kind of tell people, hey, I have a fund, I have a deal coming in. The fund is going to be investing in it or owning it. And then the limited partner gets the opportunity to see the PPM and decide, yes, I want in on that deal, or no, I don't want in on that deal. And let's say that, you get 20 investors, you fill up that first deal, and then another deal comes around, you offer it to the same investors, and they're like, no, I ran out of money, or I don't want to invest in this deal. They actually have the choice of saying no. So you put 4 or 5 deals into this in a year or 2 years, or however long it takes you, then they can choose which ones to go in, and yet still be diversified amongst the ones that they chose to go in, and exclude the ones that they didn't like. So this is kind of a sexy option. It's not blind. It gives the investor the option to invest in something or not. But in any situation, unless it's a one-off deal, you probably don't want to start a fund unless you unless you have a certain number of deal flow. If you have like one deal and you're trying to have an open-ended fund and you only do one deal in it, it probably doesn't make sense from a financial perspective to do a fund at this point, unless it's like a special purpose vehicle that's only going to invest in one deal and then be done. And then you typically buy a cheap fund, like $7,000 fund. There's people that do that. I think Lance Peterson's got an SPV and a Vox, and our particular syndicating attorney of choice for this type of, one-off deal fund is Nick Moore, who I believe charges around $7,000 for one fund, which if you're only going to do one fund, there's not enough arbitrage between what the sponsor is giving you and what you're giving your investor for you to make money, unless it's relatively inexpensive, depending on the size of the deal, of course. But $7,000, you can make that up and then charge it to the investors, and still give them a very good return, because typically when you have a fund that invests in your deal, you're going to offer them a little bit more than you would offer your $50,000 retail investors. You're going to say, hey, instead of an A pref, you guys are going to get a 10 pref. Instead of a 19% IRR, you're going to get a 22% IRR. So you make that little split of money and then offer that to your investors. And sometimes you can't even have the option to co-GP, because if you can only bring in $500,000 and the minimum investment is 1.5 million, then you're going to need to have like 3 or 4 capital raisers come together, build a fund, and then come in with that 1.5 million. So that's going to be one of the reasons that you're going to want to start a fund too, is so that you can even have access to some deals that require a larger investment. So this is like the stuff that I talk about with fund managers every day. The other thing that was very interesting when I talked to Ike Mutabana, I was asking him about, like if I'm in, and I was asking particularly to my situation, I'm like, hey, I want to be a fund manager. And, in the past I've raised from JVs and from co-GPs. How do I put this? Is it legal? Is it cool? What can I say if I'm bringing capital raisers into my fund that invest into another fund? And he thought about it for just like a second or two. And he's like, dude, I think what you just asked me to tell you how to do is create a Ponzi scheme. And I was like, what? Like, I didn't mean to do a Ponzi scheme. He basically told me like this. He's like, if there's a fund that invests in a fund that invests in a fund, then you're creating all of these layers. And then the money's not going direct. It's hard to track. The IRS doesn't like that. They'll flag it, et cetera, et cetera. But here's what I found out, because I talked to Vinny Chopra, and I know that he raises from capital raisers, and what he offers, and I talked to him if I was you and wanted to raise $1 million, but anybody that raises $2 million for his deals, which he owns, by the way, or like directly manages. He's an operator on it. It's not a fund of a fund. So a capital raiser that brings in 2 million, he'll buy you a fund. He'll pay all of the docs, and then you basically get a free fund if you raise him 2 million. If you raise 1 million, he'll pay half your doc fees. If you're paying for less than that, then you can either co-GP or some other kind of structure. But I thought this was fascinating. But what happens is, to avoid the Ponzi scheme, the fund can't have a fund invest into it that then invests into the syndication, but the fund can actually own properties. So like Vinny owns all of his properties. The fund itself is the operator of the properties. And that's why he can get a fund to invest into his fund, because his fund invests in a bunch of deals, but they are the owner of those deals. If I had a fund that was investing as an LP in someone else's deal, and I wanted to bring a capital raiser in, I can't have them start a fund that invests in my fund that invests in that syndication, because that's a kind of a Ponzi scheme. What I can do, though, is if I have a fund and I want to bring capital raisers into it and kind of share the wealth, what I can do is make them part owners of my fund, and then that fund can invest in a syndication. And that prevents the too many layers and too many Ponzi schemes kind of situation here. So these are some of the types of things that I think about when we're talking about funds. Let's see if I can go through some of these questions. Having a podcast platform allowed me to have conversations with people I would have never otherwise reached. I just need the email address. So yeah, that's an interesting part. So the lead capture, if you have a podcast and all these people are listening, but you have no way to capture their email, then that's kind of a flaw that Michael Blank likes to talk about, you need to have some kind of marketing capacity to capture their email. So what I've decided to do, because everybody needs a really powerful lead magnet, and a million people have these passive investor guides that you can Google and get 1 million of them or 100,000 of them or whatever. Everybody's got one. They're not really enticing. People don't sign up for that unless they're really niche specific. Like, hey, this is 5 things that a CPA should know before investing into a syndication, or they're targeted down a little bit further. I'm going to write a book on capital raising and talk about a lot of stuff that I talked about today, a physical copy. And then I think Anthony Vicino said, hey, once you have this thing written, bring it to me. I'll help you get bestseller status. And I'm like, well, to get bestseller status on Amazon, I won't be able to capture the names. Like, don't I buy the books and then offer them in exchange for a name? And he's like, you do that after you get the bestseller status, because first you need the reputation, then you go and then get the name. So I thought that was really cool. But you need to have a really powerful lead capture. And this particular lead capture is going to be geared for the capital raiser, not the LP. And my show is geared to the active investor, not to the LP. So if I start some kind of meetup for capital raisers, once again, you meet people that you can bring into your fund, and we discuss the different options that these capital raisers have. Once again, they can either become their own GP, they can go and co-GP, or they can start their own fund. You know, we didn't really discuss the options of, because all of my first shows were on LPs, but then I found about these things called family offices and institutions and broker dealers that provide money for you, and these big check writers, and that's a whole different ball game. I guess I'll take a minute here to explain what the differences and the benefits are of raising from LPs versus raising from these big institutions. So the LP is great because you have a lot of control. You can charge fees. The limited partners are not going to ask you for any controlling, you know, like, hey, you should put paint here or get this brand of et cetera, washing machine into your apartments, or that you should, you know, resurface the deck. They're just going to ride your expertise and get that check. As soon as you start getting money from big check writers, they're going to want to have more control. They're going to want to cut out your fees. If you tell them your business plan and then tell them, hey, there's this unexpected charge, they're going to be fed up with that. They're not going to like any deviation from your plan. And if you misperform, they can kick you out of it. They're going to require that they write legal documents for that. So the benefits of raising from LPs is you have a lot of control and can charge fees and make a living. And the only problem with it is that you have to manage like 50 investors, right? So if you get money from one institution or one family office and you do good work, they are going to charge, they're going to remove your fees, but now you're not going to have to worry about capital because it's going to come from one source, and it's going to give you the ability to have great momentum and scale, because now you can just go and focus on your thing, your acquisitions, and repeat your business cycle and process and have that money available to you all the time. So you're going to get less per transaction, but you're going to be able to do more transactions. A lot of people say, oh, I can do as many transactions as I can. I have deal flow. I just don't have the money. If that money resource was solved, even though you got less per deal, that would be a case where you would get the benefit of working from them. But one of the scary things that I heard, I think from George Abreu and a couple other people, I think Joseph Bramante as well, is that, and David Hanford, you can actually, if you're getting money from these sources, they can kind of leave you hanging right before closing, because they may have found some other lucrative deal that's more, that, you know, that covers their losses on your deal, and then more than doubles it or whatever on some other deal. And 5 days before you're supposed to close, boom, you're stuck with all of a sudden have to raise capital for the remainder or the majority of it, and you're just out of time and you're screwed and you lose your earnest money deposit. So one thing to do to solve that is to make sure that you have the capital in the bank 30 days before close, or if you're going to be slow to get the capital in the bank, make sure that the big check writer has some earnest money deposit or something to lose before, you know, you close, because it's going to be painful for them to just disappear and find a better deal. and then, they're already committed to you. So these are some of the kind of the differences between, when it makes sense to start from LPs and some, when it makes sense to raise from big check writers. But, the option that I really like is let's raise from neither LPs or institutions. Let's raise from capital raisers. And that's why I discussed how do you do that and what are their options as capital raisers. The one option that I really like in this particular way of capital raising is to make them part owners of your fund and then invest hands off into somebody else's deal. Some people will say, oh, well, I want to get my GP card and I really love to see the asset management and construction and all this stuff. And I tell them, like as LPs, we're not going to be doing that. But knowing this in advance, we can take the Abel Pachecos of the world and say, hey, we want to have some operating duties so that we feel, like that we can participate in the ongoing duties, and that will satisfy some capital raisers, because they can actually have more of a GP card because for whatever reason, that's what they like to do is manage and participate. Me, I'm not that really interested in, the acquiring and managing of assets as I am, and just going out and making friends and meeting sponsors and capital raisers and attorneys and all these kind of crews. And then, to some extent, I definitely like talking with limited partners as well. It's just a lot slower to work with limited partners because you have to nurture them over long periods of time in order to get them to invest with you. But they're great. Okay. Can you put the names of Joel and Ike in the chat and how to reach them? Let's see. So
just to Ike's, if you would, Ruben, I already put the LinkedIn connection for Joel and Lance in the chat.
Cool. So then who's missing? Ike?
Ike, yeah.
Well, yeah, same thing. So let me spell his name. Muda Bana.
Ike's actually in the chat now.
Really? Oh,
Somebody-
his contact information.
Yeah, somebody put it in there.
Okay, fantastic. So yeah, just look them up on LinkedIn or go to their websites. Go to their LinkedIn's, find their company website, visit them, and then there should be accessible there. Or just message them on LinkedIn is what I would say. So Joel is fantastic. He's a little expensive, but he'll give you some brilliant advice. Same thing with Lance. Sometimes he can be a little bit like, I don't want to talk to you unless I think that you're going to do business with me. But he is absolutely brilliant. He talks about another type of fund, which is what we refer to as a series LLC fund. These are Delaware-based funds, and some people call them super funds because if you know that you're going to do multiple funds, you start one major LLC, and then that LLC launches a fund every quarter, and it costs a lot less per fund document fee because like the main setup is through the first LLC, which is the most expensive, but then every additional fund after that is a lot cheaper. So it's like this spaceship model where you have one master LLC and it launches a fund every quarter, which are like the legs of the spaceship. So Lance knows about that. Not a lot of people talk about the series LLC or their super fund, but that's something to think about. What do you consider a big check writer? So the big check writers are the people that are going to say, hey, I'm not even going to consider your deal unless I can bring $5 million. If you're talking to an insurance company, by the way, a lot of people don't know that insurance companies that are paying, receiving premiums from a lot of people for life insurance policies, they have to make money on that money, and they invest into multifamily and other assets, but particularly due to the recession resistance, they like multifamily, but they won't write a check that's less than $25 million. So these broker dealers, these family offices, some family offices might stroke you a $2 million check. Or partner with other people. If you get in with a family office, the nice thing is if they like you, they're going to tell their family office friends about you, and that's going to get you more money too. But typically when I say a big check writer, I'm talking about $5 million and up. Some people won't even invest with you or look at you unless you can do a $10 million raise. And obviously if you're doing a $10 million raise, now you're talking about a $50 million project. So if you're not a sponsor that's doing $50 million deals or need a minimum check of 5 million, you probably want to raise from some other source, which once again, my preferred method is getting capital raisers. And to do this legally, you have to have a fund if you want to bring them into your deal. Or if you're an operator, you can bring them directly into your business as a co-GP let's say that you're really good at finding and acquiring deals, but not so good on the capital raising side. This might be a good opportunity for you to get a co-GP into your deal, or to reach out like someone like Andy and myself, and our fund can invest in your deal, once we vet your deal. We get a lot of people requesting money from us. And they're like, hey, Mr. Capital Raiser, send your check here. Or other people are like, hey, I got a deal. It's phenomenal. It closes in 10 days. I know that you raised for other operators. Come on board. And we're just like, dude, we don't know you. We haven't planted seeds for your deal. We don't know what we're going to make. We don't know, what the investor's going to make. And we're not really interested in doing something with such an aggressive timeline. It doesn't make sense for us. But keep in mind that when you're seeking capital, you want to have those relationships in place way before your deal is about to close. Let's put it that way. So I'm a sponsor. If I understand you, I could have a fund that investors, LPs put money into, and then could also have a capital raiser with 15 investors invest in my fund. The capital raiser will not invest in your fund. They will become a part owner of your fund unless you are the owner of the property. And in this case, the fund or the sponsor can own the property, but you can't have a fund invest into a fund that invests into an operator's deal. You can only have a fund that invests into an operator, or if it's a fund that is the controlling operator of the deal, then that fund can invest in that fund. But you don't want to have a fund that invests in your fund if you're investing into someone's syndication and raising capital for somebody else. And let's see, and their 15 investors invest in my fund, so they do not have to have a GP role. They can't have a GP role unless you're the controlling sponsor or fund of the deal. And that's what makes capital raising so sexy, because in order to, instead of the co-GP role where you have to have an ongoing duty and make it so that like you have to structure like how much you're going to get paid, and it can't be based off of the money that you raise and all of that, and the negotiating, and you don't know what your investors are going to get after your piece and blah, blah, blah. It's too confusing. So when you have a fund that you already establish exactly what you can pay to your investors and the roles that they're going to have with, which is essentially just communications and marketing, then it's a lot easier to understand that and just offer them, and they either like it or they don't, and they see your business model and what you're investing in, and they can choose, very quickly, hey, my investors would like that or they wouldn't like that. So it's very quick to make a decision about partnering with a fund as a part owner of the fund. Have a validated fund around scaling proven real estate model seeking raiser GP. I'm not sure if that's a statement. It looks like it's a statement. What other kind of questions do you guys have? Do you want to open it up for chat? How about we just kind of, instead of questions in the chat, can we get everybody off mute that wants to talk and ask me questions directly right on here?
So Ruben, you said that a fund cannot invest in a fund that invests in a GP, but we hear the terminology. Yeah, we hear the terminology constantly, a fund of funds.
Yeah.
Could you explain how that's different?
So some people, yeah, let me start with this. Some people say that a syndication is a fund. So if you have a fund that invests into a syndication, which is also referred to as a fund, that is a fund of funds. So far, so good? So that's what we're talking about when we say fund of funds. It doesn't mean fund to fund to fund to fund to fund. It just means one fund that invests into a syndication, which is some attorneys refer to as a syndication, as a fund, as a crowdfunding vehicle or instrument. What else? What else you guys got? Or do you want me to expound on that a little bit more, or what else, Jim?
Well, if you know of other circumstances, is this something that's particular in the way the fund of funds works? Is it something particular to real estate and or syndication? And then the follow-up to that is, do you happen to know which section of the SEC?
Oh, hell no, I'm no lawyer. Hell no, I'm no lawyer. So let's find it. Let's describe what a syndication is. And a syndication is just when people come together for a common goal. And in syndications, you can syndicate a bunch of different things. You can syndicate real estate. You can syndicate oil and gas, which some people also consider real estate. You can invest in airplanes or syndicate movies, casinos, hotels, baseball teams, et cetera, et cetera, et cetera. So these rules and regulations and the crowdfunding and securities laws refer to syndications in the same way, regardless of what the syndication is investing in. Hopefully that answers your question.
I have a question. So you were talking about this blind pool fund, and then you're talking about, bringing the other capital raisers who can come in, and then you could GP into the fund so you can invest into a project. But in that case, are you doing a blind pool fund and creating a SPV for a particular property? Because they cannot be, the capital raiser cannot be part of the blind pool fund, right? Otherwise, they're gonna be like part of each and every deal that you're gonna bring into that pool.
So I haven't talked enough operators that run a blind pool fund, but from the ones that I do know that run blind pool funds, those blind pools are the actual operator and owner of the deals that they do. So I don't even know that once you feel like you can raise for, whatever you want to and blindly, that people even want your money at that point. So they're not going to be like, yeah, Vinky, come in with your fund to help me. Like, I already am so good that I can like put whatever I want in there and the money's coming already. So I don't know that's typical for some operators, but then again, you just don't know. I've talked to some people that have been like, hey, unless you can bring $1 million, I don't want to have you participate in my deal. So people are picky. And then the other thing is like, they don't want you to, some of them don't want you to share that you closed on the deal that, they raised from you for. They don't want your name associated to it because they want their name only. They don't want like 8 GPs all bragging about the same deal and kind of diluting and confusing who actually is the owner. So they're like, hey, dude, like it's got to be my company on all of the marketing, and that's it. So there's different things to think about. I'm not sure if I answered your question, but with a fund that invests into a fund, I think you kind of caught the gist, right? The fund that invests into the syndication can bring owners, you call them GPs, part owners of that fund, and they can invest passively into someone else's deal.
And the other thing you were talking about earlier was raising capital from the institutional investors or the family offices. So can you shed some light on how to build the relationships with them and how to nurture those relationships?
It's tough. Like, I don't even know how to find them. And there's a lot of places where you can find them that charge you money to find them. Like just, I think, I don't know if you guys have ever heard of Ryan Enck. He's a hotel. Right now he's doing hotel to multifamily conversions. He paid $17,000 to get access to a family office event here in Phoenix that only had 100 people. Like, could you imagine spending $17,000 to network with only 100 people? But some people will guarantee, hey, if you invest $5,000 in get in here, we guarantee that you'll make at least one connection or else your money back. But it costs money to go to these types of events. The other thing you can do is you can find broker dealers, like, or, talk about it on social media. And like a lot of these broker dealers are kind of watching you. I know that they're probably watching me because they tell me so, like, oh, I've seen your show, dude. But, once you get into the space where you can, when you need $5 million, reach out to me, we'll help you then, but we won't even look at anything under that. And typically it's more in the $10 million range. So me as an operator and in the capital raiser, we're not in that range. We typically raise about $1 or $2 or $3 million. And that's like our capacity right now, unless we work with other capital raisers.
Oh, great. But so a follow-up question for you. So I know there is like some smaller institutions too, like they can go by with 2 million, right? It's not 5 million.
Those are rare.
Yeah, some are there. So for those especially, how do you nurture those relations? Like you are not forgotten, like let's say 6 months, I do not have any deal for 6 months. I did not talk to them. And after 6 months, I reach out to them. Hey, I have a deal now. And they totally forgot. They're like, okay, remind me who you are.
Yeah. Well, hopefully they're not in New York and have that cold business mentality, because that's hard to network with. And the most of the people that I know are based out of New York or have access from New York and live in New York and are used to that fast mentality. Like, hey, I talked to you 6 months ago. Who are you again? So I don't know, because those people are just like a different category of business. They have a different kind of business mindset where, like, what did you do for me today kind of mentality. So I don't know. I'm not good at talking to those people, honestly, and maintaining relations. Hopefully, like when it comes to a family office, they're a lot more personable because they're real people. And you're not talking to the Wharton MBA that manages their money, but the actual like real dude that made his way to become successful, like the Spencer Grays of the world, that done 9,000 units, but started from scratch and became family offices along the way. Those kind of people, I think, still remember their roots. But some of these people, you know, like that have been in a family office for 3 generations, you know, the 3rd generation is the one that loses it, and they don't want to lose it, so they just stay out of it. And then, like, how do you deal with that, you know? So I don't know.
Oh, thank you. Anybody has any questions, please take yourself off mute and ask. This is your time.
Ruben, I
Yeah,
have a question.
Go ahead, Jeff.
Yeah, go ahead, Jeff.
Is in regards to the compensation for your capital raisers or folks that, you know, bring capital to you, how does that work? What does that look like? Obviously, they're not managing members, right?
They are. They become officers of the fund. That's the best way to do it. So typically across the industry, you know, there's a 70-30 split in a syndication. 30% is the GPs. And of that 30% share for the GPs in this hypothetical situation, I'm not a lawyer once again, then you basically allocate another 30% of that 30% or 9% of the total deal specific to the capital, but they have to do other things besides capital, right? So this is where it kind of gets muddied a little bit, because you can't pay somebody for only the capital. You have to pay them based off of the total scope of everything that they do, including, you know, investor relations or underwriting or walking the property or some kind of ongoing duty. When I'm paying a capital raiser to join my fund, the only thing that they have to do is basically manage their investors. So this is what's kind of sexy for me. We don't have to worry about all the other crazy stuff, but we base it off of what they can bring and how well they can manage their investors, because they at least have to do that. But it's the same kind of gig where a percentage of the company is allocated to business partners that can bring capital and other skill sets. And then we just give them, you know, an overall package based off of their overall skill set and what they can bring to the table as part owners of the fund.
Ruben, Ruben, so when a fund joins your fund, do you then see, you know,
A fund can't join our fund.
or all right, so they just bring their capital.
Yeah,
to
so
your
a
fund?
person can bring money and become part owner of my fund.
Right,
but
right.
I don't
I'm
think
sorry,
a fund
you-
can own
yeah.
my fund.
Otherwise you got the layers. So anyway, when they bring their people over, do you have like visibility into those investors? And is there some sort of like agreement that?
No, I don't.
How's that all work?
So the co-GP tools like portals, like Syndication Pro, and I think there's a bunch of other ones. When you set up a portal and bring a capital raiser or a co-GP into your company, the portal for the main project gets split and divided, and the person that comes with capital, they have their own portal where they're the ones that sees their investors, and you as the operating owner of the fund or operating sponsor do not have access to their investors. Now you can pay them, you know, but you basically pay the co-sponsor or the guy that's got the unique portal, and then they distribute however they feel fair to their investors. But that's the way it's managed. You don't get access to their investors.
Okay. Thanks.
Good
When
stuff.
I was going to ask about when we're going back to funds. If you have a fund that is, like, I've seen certain funds that operate 70% of the time, and then 30% of the time they're investing in syndications.
Yeah, I'm not the right person to ask about that, but that is common.
Okay.
I guess it's not, I mean, I say it's common. It's not a lot of people do it, but I have
Yeah.
heard of that frequently.
So one of the things that have come up recently is we've got a lot of people that are co-sponsoring. From a lender standpoint, a lot of people want to be on the GP, right? So when you start to ask the question, so are you a GP? Yes, I am. Have you signed on the loan? No, I have not.
That's another thing to contemplate, right? Whether they can actually have that as part of their skill set and what they can bring to the table.
So, you know, you have to make sure that, and this has come up recently because Freddie is looking very closely at who is signing on the loan and who is part of the member managed entity. So you got to make sure that if you're interested in getting on the GP, you have to sign and you have to be in control of that manager. You have to be part of that managing member.
Julie,
at
how
the
much
same-
do they have to bring in order to be designated as someone that's got to be underwritten? Because if you got a bunch of $50,000 investors, they're not going to underwrite each one of those. But if somebody's
Well-
bringing their entire capital in one check, they will
you go,
be
Lyle.
underwriting.
Everything is different.
Right.
Every deal is different.
So that kind of brings me back to your point. I believe it was you, Peter, that asked about this. Like, do you have access to the investors? Will I be able to see them if you bring them to my partner? I will not be able to see them, but a bank may be like, hey, where's this money coming from? Is it coming from one person? If so, we're about to underwrite them, but if I still won't know whether it comes from one person or 20, but the bank will definitely find out from you how many are on there. And
So
if it's one big
typically-
source, they'll
Yeah.
underwrite them.
So typically we've seen 25%, if someone's bringing in a large amount, they'll say, I want to underwrite that guy. Now that guy who's bringing in 25% may say, I want to be part of that GP. You're hoping that he doesn't, right? But if they have to underwrite them, they're going to do a background check, and that's fine. No big deal. This background check, it starts sometimes at 10%, sometimes it's 25%.
Mhm.
So you just got to kind of figure out what the lender is looking for. Jim and I are on a deal right now and it's 10%. Typically, Jim and I have seen it at 25%. So if you can keep someone at 24.9, that's even better. Then they don't have to, be underwritten with, they don't have to be a guarantor,
Yeah.
if you will.
That's what's kind of cool about working with a savvy lender like Julie, because she can kind of tell you, hey, you're going to pass this threshold and get underwritten if you meet a certain point, a certain line. Let's keep your investors under that. They can kind of guide you based off of whatever the lender's, program is and what they require for underwriting.
One of the things that I think is really cool about this fund idea is that you can be a sophisticated investor and you can have a fund and now you can go into accredited.
That's true. That's a good point that I didn't bring up, because you can start your own fund that's a 506B and then access 506C deals. I would definitely talk to a lawyer before you do that. However, it's very possible.
So we are very interested in trying to figure out that piece of this fund model, which is how do we create an accredited fund that's filled with people that are not all accredited.
So it's a security, right? As soon as you tell the lawyer this is going to be a 506C, then it's accredited only in your fund, my brother.
Right, but the ability of the B to invest in a C is the piece that I think is the magic key that we're trying to figure out.
Well, so when you're talking about launching your fund, are you talking about investing into other people's deals or your own deals?
Both.
Okay, so now you got a 506B and a 506C, and you're the owner of both of those funds. Your 506B cannot invest into your 506C because now you're crossing that threshold that makes it illegal, where sophisticated people are entering into a C. Now, if you start a 506B that's investing into somebody else's deal, that's a 506C. That's a little bit different. Now it's not like that conflict of interest thing going on. So just keep that in mind. And once again, I'm not a lawyer.
Here's one of the big things with trying to figure all this out, Ruben. This whole space has exploded, as you know, over the last year, and particularly because of this whole subject around raising capital and capital raisers and how they're compensated. And the broker-dealer network has a big lobby, and that has put a lot of pressure on the SEC, and so there's been a lot happen this year, and people are really exploring this fund model. And I've heard not only about the piece that we were just speaking of, but also about investing on both the GP side, which is what we typically think of where the capital raisers would land, but also investing just on the LP side. And have you heard of that? Have you explored that? And have any thoughts on it?
So who would be investing on the LP side, a fund or a
fund.
person?
Yes, a fund.
Yeah, that's what we do. So when we raise for our build to rent, we own that build to rent. And that is a one-off fund that works in conjunction as the capital piece of the GP team. And then when we raise for other people, our funds that we do for those other sponsors are limited partners into those sponsors deals. So our fund is an LP in their syndications, unless one of our capital raisers says, I want my GP card, and wants to have some operating portion. Then we just come into it knowing that we're going to be operators.
So how the fund is compensated, is that a taboo subject?
So if there's a sponsor, and how do I get compensated as a fund manager, and how do I, after getting paid, still pay my LPs, is a topic that needs to be addressed, that a lot of people are scared as hell to talk about. And I don't get it. Like, just be open with it. You just basically take the arbitrage. So I think we mentioned that. Maybe I didn't go into too much detail. A sponsor is trying to raise $5 million. My fund can come in with 2. They're offering 15 or 17% IRR plus a 8% pref or whatever there is. I negotiate with them. Hey, Mr. Sponsor. Hopefully I don't call him that because I know him. So I'm like, hey, Jim, I know you, dude. How about, instead of you having to allocate 30% of your GP to the capital, piece and that, how about you give me part of that GP, or the equivalent in terms of money plus an arbitrage, and allow me to pay my investors better than your typical retail $50,000 investor. So that way I can pay myself, write you a big check, and then there's still enough money for me and enough money, if not better, for my investors than they would get if they came in as a $50,000 GP in your deal. Because here's the other thing too, is like, you don't want your investors to just go, like, why would they invest with you when they can go direct to the sponsor and pay them $50,000? Well, hopefully you've negotiated terms that if they come and invest in your fund, then they're going to get a little bit better return than they would if they went direct to the sponsor, thus preventing them from wanting to circumnavigate you. So there should be plenty of meat on the table from the sponsor if they have you write a big check so that you can get paid, or at least something, and build a momentum if it's your first fund, because you don't want to be money hungry on the first one. But if you have a fund, you want to have enough to pay yourself and keep the lights on and not go bankrupt and not be forced to go back to corporate America or whatever. And then you still want to have enough to pay your investors. And I think that's a topic that should be brought up as much as possible. And some people, I wouldn't say that they're scared to talk about it, but in this world, remember that these things are called private placements because they're private, and people don't want to tell you how much they're going to get paid, or they don't want their investors to know how much they're getting paid, because then that makes them look like, oh, this dude's getting paid for helping me, like, that's messed up. It's just the mind, they don't want this to be exposed to the world or talked about on a podcast. But in this kind of group setting or with me, I'm happy to talk about that stuff. I think it needs to be talked about. But the reason why some people consider it taboo per se is because they are private. That's one of the reasons. And the other thing is they don't want to get busted, right? So
yeah,
legally, they don't want to say something stupid because they're not lawyers either.
Right. So in your experience and all the people that you've been talking to on your podcast and privately over this last year, the people that are setting up funds that you are aware of, are most of them also taking a fund management fee?
So most of the people that are setting up funds are not setting up to raise for other people. I don't see that very commonly. Most of the people are setting up funds for the express reason of having the soft commits in their fund that can fund their deals faster than their existing ability to raise from a bunch of little investors one at a time. If they can have that money soft committed in a fund and ready to go because they have enough deal flow, they're setting up funds for their own deals. So that's what I'm seeing.
I have another question for you,
Yep.
because like on the fund structure, so let's say if the capital raiser comes up with, a few other people who have their own LLCs. They have tons of money sitting in those LLCs. So why wouldn't a capital raiser create his or her own fund to go in as a GP with somebody versus, going with somebody else's fund?
Some people do. Absolutely. they
Because
do.
that way you can negotiate, you can give them, is it legal to do that? Give them percentage?
So in this
are
kind of
coming
case,
in with
in this kind of case, a fund, because of their capacity and experience level, will probably want to invest in a syndication, not as a limited partner in the syndication or even operating partner in their syndication. What they'd want to do is invest side by side with the operator into the syndicated property. So, it's kind of at that point a JV agreement.
So yeah, it's a JV, but in a syndication deal though, right?
So, it'd be a syndication deal, but there'd be two side-by-side people running that syndication. Instead of like somebody savvy with the fund, investing as an LP into somebody's syndication, there may be some people that want to invest side-by-side and have control over that asset, whatever that may look like, however they come to agree with that. And their lawyers would handle all that. Some people like that though. Some people like the whole side-by-side thing. Some family offices don't invest into deals. They invest side-by-side with deals, and that even though you're giving up a piece of the pie, you can have access to the ability to get across the finish line. And that's important to some people more so than like getting paid for raising the capital, et cetera, et cetera.
So basically you can structure it anyway, as long as your attorney blesses it, right? I
Yeah,
mean,
there's a
it's pretty
million
much
ways-
everything is negotiable, whatever way it works for
There's a
you.
million ways to skin the cat.
Exactly. Yeah, I think Jay has a question too. I've been seeing her hand raised for a while.
So I'm not trained to look for the hand raise, but Jay, go ahead.
Thanks a lot. So this has been wonderful information. I was just wanted to get your perspective on a private performance-based fund where a GP, how many GPs in your experience that are actually have the raising talent and that's their primary role are attracted to the ones where they're not required to put anything in, but at the same time, for this particular fund, I can give a lead LP a GP position where they are compensated earlier than a regular raiser GP that, according to this structure, they're not paid until the bulk of the LPs or all the LPs get their percentage. And then, the management being the GP, myself, and the fund manager, that's when we're paid. We're not paid until the rest of the LPs are paid first.
Yeah, so typically the GPs get paid last, right? The LPs get paid
Right,
first.
right.
But did you mention an LP that's got a bigger than normal LP amount of check that you make them part of the GP or something like that? I'm not sure if I heard
as
that
an
correctly.
option. Yeah, that particular individual or individuals, one or two, they have the option of either having a partial GP position out of my stake, not the other two, so that it comes out of mine, or they can have some admin, the admin costs waived once all the rest of the LPs are on board, or we reach the amount that we need for the first phase.
And then you are the GP or you are a fund manager that owns a syndicated property?
Well, it's a scaling private performance-based fund. It's not one syndication because the model itself actually replicates in different locations.
So you're talking about a blind pool fund or some kind of fund that invests in a bunch of different assets. There's a lot of moving parts, I think. I'm not sure if I'm getting exact. I need you to narrow it down a little bit more because there's all kinds of variables here.
Yeah, well, my main question was, on the topic of the GP that is the primary fundraiser, is it, some of them are, how many, how many of them are, how many?
You're talking about a fund that invests in a syndication or a fund that owns the syndicated property?
Well, I don't like to, I don't like to use the word syndication if it's a scaling model, but you're the expert, I'm not, because they actually scale, they replicate. So it's not one property at a time. The fund invests, the members invest in a fund that repeats and it's transparent. It's not like they're told, it's full disclosure of what they're investing in. It's not like we're just replicating a real estate model. They know exactly what those models are. My question was, are GPs that are primary raisers, they embrace, being compensated because they're independent. They shouldn't need the potential of the fund once it gets going, once the snowball starts rolling down the hill. They're going to get paid a percentage once it starts to grow after all the other LPs are paid. So the question is how many GPs are embracing that model in your experience?
Okay, and when you say GP in this scenario, you're referring to fund owners and fund managers?
I'm referring to the one that has the primary raising role.
Okay, and in this case, if I'm gathering correctly, this fund invests into a business model that you go and take down multiple of the same business model, and you're specifying your question around the owners of the fund that has this model and brings in capital, right? So an LP that goes into this fund is going to get paid first, typically before the GP or fund manager. And you're actually also asking a secondary question where if one LP has a significant amount, can you make them part owners and get paid separately and distinctly, or maybe kind of as an LP and as a fund owner? And the answer is yes, but that sounds like an accounting nightmare. But you could potentially do that, and you could make them an officer / owner of your fund, which is a security in itself that has to follow exemptory laws and stuff like that when it's doing capital raisings. Hopefully I got that.
Yeah, they could be a fourth person because they're a lead LP. There's still two other individuals besides myself.
I've never heard the word lead LP before.
Yeah, it's basically the LP that puts in the money first.
Okay.
Do you treat that any differently?
So here's another kind of thing that you might be talking about, but maybe not so much in a blind pool fund. But an LP or a group of LPs comes into a fund, then that fund has a model to buy multiple assets over time, and then they invest into that first asset. About 8 months later or 6 months later, asset number 2 becomes available into the fund. And now that money, or I should say that fund, is still acquiring new investors. And there's people from the first round that are in the first deal. And now there's second people that are coming in that don't get access to the first fund or any of the returns associated because they're now coming at a later date and only investing into the next deal, and yet still able to diversify. So that is a little bit of an accounting nightmare. And that's why you want to have either really good accountants or some specialized software that tracks that type of stuff. Lance Peterson has some software with his company Veravest that specializes in doing that. And it's so good, in fact, that he charges you a percentage of exactly how much you raise for these ongoing capital raises, where you're constantly raising for new deals as they're coming and trying to manage what portion of the return goes to each segment of people based off of how long they've been in the deal, right? So that to me is an accounting nightmare. I'm not an accountant. I wish I could help you more on that.
No, well, you kind of get it, but it's another conversation. My original question was just, do GPs who are primary raisers, that is one GP role in this particular fund, are they, in your experience of all GP raisers, because you seem to have your finger on the pulse of those, they like these types of models where they're paid after the LPs are paid, provided it's a lucrative model.
Yeah, there's not a lot, honestly. I thought that I was like the inventor of the model. Apparently there are some people, but as I mentioned, the majority of people that start a fund, they start for their own deals. They're not people like me and my group that have a fund designated specifically to invest in other operators. It's just not common. I don't see that very often.
Okay, so thank you very much. I'll be in touch.
Cool. Yeah, feel free to reach out. Let me put my calendar link if anybody wants to get on my calendar. It's also on my LinkedIn if you don't save this.
Yeah, please. Yeah, please share your contact information, Ruben. So do you have like a page that we can share in?
Yeah, just go
The
here.
contact information, yeah.
You can find me on all the social, but I'm not on Twitter, but you can find me on Instagram, LinkedIn, Facebook. Send me a message there. You can go right onto my calendar, which I just put in the chat. I wanted to bring up one more thing, actually. I got a text from somebody today. I wonder if I can read it out loud. I won't mention who this is from. He says, hey, Ruben, I've got a quick question. I was thinking about getting my securities license to raise capital. I was trying to understand the difference between Series 6 and Series 7 license. What's more common for syndications? My response is, don't do it. You get a license and you will have to hang it with the broker. Most brokers don't sell syndications. Plus, you'll be required, or I should say, you'll be regulated severely, and your broker may not allow you to raise outside of his brokerage and his particular offerings. Instead, my advice is go start a fund. So this is something that Hunter Thompson spent like 6 months of his life getting his securities license. And I've heard that he made a mistake. And then I've also heard it actually helps him. I think he's conflicted. Maybe he's got one particular mindset around it now. But my understanding is when you get a securities license, you, just like a real estate agent, have to hang that license with the broker. And if you want to participate and be legally sound in your capital raises, and that's why your objective to get the license in the beginning is, understand that it's going to be hard to find a broker that sells real estate, particularly niched real estate like multifamily syndications. And that once you have that license hanging with the broker, if you want to go raise capital for Jim Biggs or somebody else on the call today, that broker is going to be, oh, hell no, you can only raise for me. So this is stuff to think about before getting your license.
Thank you, Ruben. That was very informative and very insightful session. We are like an hour and a half. Oh my God.
How long do these typically go?
We give 1 hour and we have a half an hour for networking. But today, oh my God, this was super awesome. And everybody's still here. Thank you, everybody. Everybody's favorite topic, you know, and then I think you have shared golden nuggets, bunch of golden nuggets with us. Thank you so
Awesome.
much.
Yeah, it's been a pleasure. Thank you for inviting me here. Hopefully I can figure out how to get back on here as an audience member. I didn't even know that this existed.
Yes, every other Friday. Please join us.